Welcome everyone, doing an audio check. If you can hear me on Facebook or YouTube, if you would, just type something in the chat letting me know that our audio is good. Just doing an audio check. See, we have a few people that have already joined in. If you Facebook or YouTube, if you just let me know that you can hear me. I want to make sure that we're good to go. Okay. Thank you, Terry. Appreciate that. Kitty, thank you. Anybody on YouTube yet? See, it looks like most of the people joined Facebook. Okay, Joyce is voting for trivia. All right, Joyce, let's do some trivia, shall we? All right, let's see. Okay, I'm going to vanish for a minute. How much was the monthly payment of the first benefit? So if you'd like to participate in the trivia, just type the answer into the comments or chat section on YouTube or Facebook. You know, if you think it's A, $28.17, punch in an A. If you think it's $16.44, punch in a B. If you think it's $3.42, try a C, and then D for $22.54. What do you think? How much was the first monthly payment, the very first benefit ever paid? What was the amount? Let's see what you think. Okay, we got some D, C, okay. Not so sure. No Googling, no cheating. Okay. All right, let's see. The answer is D, 2254. I have a book coming out here soon, and so maybe we'll have that as a prize. We'll find a way to make it so that you can know the answer and maybe answer and win a prize. So we'll work on that. Book should be coming out here hopefully before the end of the year. We're hoping by the end of the year that this happens, but might be beginning of next year. Publishing is fun. Okay, let's try another one. 2254 for those of you who are wondering. What year? So the next question would be, what year was that benefit paid? We got A, 1936, B, 1937, C, 1940, or D, 1942. What year was the first benefit payment paid? What do you think? If you're just now joining us, we're having fun with some trivia. We're going to start the presentation in about 14 minutes. If you'd like to participate in the trivia, we certainly encourage you to. Looks like we have no participants on YouTube just yet, but Facebook is participating. And so if you'd like to, you can punch in an A into the chat if you think the answer is A, B if you think it's B, C, 1940, D, 1942. We will not tease you if you get the wrong answer. If you get the right answer, we have no prize. So it's just for fun. I was saying maybe we'll work on a prize, maybe have a prize soon. Love to do that. Personally, I would only participate if there was a prize, but I will not hold it against you if you do participate, and obviously, if you decide not to, I won't hold it against you either. What do we think? Okay, we got some votes coming in. C, Rebecca thinks it's a C. She's on Facebook. We got a YouTuber saying hello. Hello, Wolf Studios. Glad to have you. Mary Jensen also thinks that it's C. Hey, it took you a little minute to start answering, so no Googling here, okay? It's on your honor. Maybe I gave it away. The answer, of course, is C. C, 1940. 1940 is the correct answer, and that is C. Okay, Wolf Studios, thanks for chiming in on YouTube. Did the answer Studios on YouTube for my Facebookers was thinking A, 1936, but it was 1940. Okay, bonus points. Who can name who it was? Who was it that received the first payment? What was her name? Was a she. Good 1940s name. Anybody know? If you're just joining in, I see we had quite a few people that joined in. We're having some fun with some trivia. Somebody said audio got weird, my tech team. Okay, let me change that up, see if that's any better. Checking the audio check. Let me get excited about something. Overmodulation. All right, let me try this. Okay, let's go with a zero boost. And then let's get very excited about something. All right. How's the overmodulation? No more overmodulation, hopefully. Is the normal audio check good? Okay, this is just a normal speaking voice. Is my audio good? Talking to my tech team, for those of you who are wondering. Okay, tech team thinks my audio is good. Okay, Ida Mae Fuller. Ida Mae Fuller is the name of the very first Social Security recipient. In 1940, $22.54 was her benefit. Anybody guess what that would be worth in today's dollars? Now I'm really asking a lot, aren't I? All right. Still not much, but you multiply it by about 8 times. Okay, let's do another trivia question. What do you say? Let's see, let me find a good one. Okay, here we go. Under what circumstances can you get a new Social Security number issued to you? What do you think? What are the circumstances where you could get a brand new Social Security card issued? Options, of course, are religious or cultural issues with certain numbers, or B, ongoing issues with identity theft. C, your number enables people to harass or endanger your life, or D, all of the above. Okay, under what circumstances can you get a new Social Security number issued to you? What do you think? Put in an A, a B, a C, or a D, whatever you think. Okay, we got Jennifer jumping out, saying D. Edie's going with a D. All right, great. Am I saying your name right, Edie? You want to type it phonetically for me? Wolf Studies on YouTube, the lone YouTuber participant in the quiz so far. It's also going with a D. All right. We got an A coming in from YouTube. Mostly D's on Facebook. Everyone's afraid to go something different. Okay, there we go. Keith on Facebook's picking a B. All right. Margie's a D. Okay. What do we think? Here it is. It is D, in fact, all of the above. So any of these issues could get you a new Social Security number. All of those are reasons for it. So here, let's follow up with another one that's kind of tied to that. How many times can you get a free replacement for your Social Security card in your lifetime? How many times can you get a free replacement for your Social Security card? What do you think? Put it in an A if you think it's 10 times. B if you think it's 2 times. C if you think it's 7. Or D, an unlimited number of times? How many times can you replace a Social Security card in your lifetime? Just having some fun. For those of you just now joining in, we're enjoying some trivia. We're going to get started here in about 8 minutes. We got 8 minutes to go. Get some tea, coffee, water, whatever you'd like. I want you to be relaxed and enjoy this. If you're going for something a little more adult beverage down that path, just, we'll know who you are if you start typing crazy things in the chat. So just be mindful. All right, how many times can you get a free replacement for your Social Security card in your lifetime? Again, we're going to start right at the top of the hour, about 7 minutes out from our start time. If you're just now joining us, we're having fun with some trivia, and we encourage you to participate. No prizes, no teasing if you get the answer wrong. What do we think? And the answer to this one is actually A, 10 times, 10 times. So it's 3 times per year and up to 10 times total that you can get a free card. Now, I have a little homework, and I would be happy to make some kind of arrangement to reward you in some capacity. Maybe I'll give somebody a free book. I mentioned earlier, for those of you who are joining in just now, that I do have a book that's going to be published either later this year or early next year, timing pending, and so I'll give somebody a free book if they try to replace it for the 11th time, and you can tell us how much it costs. I've been dying of curiosity to know how much will it cost to get it replaced that 11th time, because you only get it free 10 times, so it's your tax dollars at work, I suppose. All right. Okay, let's see. Should we do another one? Let's do another one. We got 6 minutes. 6 minutes. So let's do another one, shall we? I think we have time for another one. This is a funny one. Okay. Why have more than 40,000 people claimed 078-05-1120 as their Social Security number? A. That number was stolen and sold over 40,000 times. B. The Social Security machine got stuck on that number and issued it to 40,000 people. Or C. It was a copy of a real Social Security card number that was copied at Woolworths and sold to thousands of people. Okay, so again, if you're just now joining in, I see we have a lot of people who have joined. We're going to start the presentation here right at the top of the hour, 5 minutes to go. We're enjoying some trivia in the meantime, and so we invite you to participate, enjoy the trivia, have a good time, put in your guesses. No rewards or winners, but I guess that means no losers, so we're in the modern age. Okay. Why have more than 40,000 people claimed 078-05-1120 as their Social Security number? What do you think? Take a guess. All right. Again, we're going to start in about 4 minutes. If you haven't already gotten your beverage, run to the restroom, all that good stuff, we encourage you to do that. We'll get started here with the presentation in about 4 minutes. A lot of guesses coming in. That's great. We welcome all of you. We're excited that you're here. Let's see. The answer is C. C is the answer. So actually, yeah, it was a copy of a real Social Security card. Actually, one of the secretaries at Woolworths, they used her Social Security card. They're trying to show people oh, hey, look, here's our wallet, at Woolworths. You can put all kinds of things in here. You can put a Social Security card. So they actually copied a real Social Security card, put it in there, and people started claiming that was their Social Security number. So exciting. Okay, again, we're going to get started here. 3 minutes out. 3 minutes out to the start time. Should we do, yeah, here we go. Let's do this one. We got 3 minutes. Let's do this one. This is a good one. You'll all appreciate it by the time we're done with the presentation. In 1984, this was the first year that people started paying taxes on their Social Security benefits. In 1984, less than 10% of folks actually paid tax on their benefits. How many people are affected today? What percentage of people pay tax on their Social Security benefits today? What do you think? Is it A, 11%, B, 37%, C, 60%, or D, 71%? Again, we're going to start with the presentation here in about 2 minutes. Okay, it's coming up quick. If you're just joining in, we are having a little fun with some trivia. We encourage participation, but it's totally up to you. But toss in your guess. A, B, C, D, what do you think? What do you think? How many people, what percentage of people pay taxes on their Social Security benefits? Any guesses? All right. Becky is not optimistic. All right. Sorry to hear that, Becky. All right, you got about a minute to run to the restroom, get a glass of water, cup of tea, coffee, whatever your choice beverage is. We're going to get started here in just a minute. The answer to our last trivia question is in fact C. It's 60%. Yeah, about 60% of folks do pay tax on Social Security. I would say that in my experience in working with people, I would have expected it to be higher, but I suppose there's a fair number of people that I don't see who that. Now, Kim is telling us that no one should be paying taxes on Social Security. And Kim, can't disagree with that one. Do not blame you at all for that comment, Kim. Absolutely feel similar to you. Okay. Let's go ahead and get rolling here. I need my clicker. Uh-oh. I got ready to go and I did not have my clicker. Okay, 1 second. Okay, we've got the clicker. We are ready to go. Let's see. Good. Okay. All right. Welcome, everyone. My name's Kyle McCauley, and I'm one of the national presenters here at Einstein Retirement Workshops. And I'm realizing, because I did not set up my room the way I normally do, that I need to just make a little bit of an adjustment here. So sorry for that. Just want to make sure that if my tech team has any problems, I can hear from them. If you start telling me there's problems like, hey, put your mic back on, I can do that. So, okay, all right, let's get rolling. Welcome, you are in attendance to what I have been told is the most popular Social Security presentation on Facebook and YouTube. And so we've had now more than 50,000 people registered to attend this workshop, and we're very honored by that. Just this year, I believe, is my understanding. And so we're glad you're here. We're excited that we've been able to continue to do this presentation at one time here at Einstein Retirement Workshops. We're traveling around the country, and we would see you face to face at various locations like a library or a university or something like that. But ever since COVID hit, we had to pull away from the travel and gatherings and all that stuff. And we have done one live workshop this year, but most of our workshops have been in this format, and we're honored to do it. We're glad you're here. It's something that we've enjoyed and been honored to continue to do. Our agenda for tonight's workshop. Number one, we are going to spend about an hour, a little bit more than an hour, on, I'm being told there's something about, I don't know what that, I think, okay, is that my tech team told me to put my name up. Okay, I think that's, you tell me if I did what you were asking, tech team. Okay, all right. We are going to spend a little more than an hour on the topic of Social Security. At the end of that time, we know two things. Number one, many of you are anxious to get a copy of our Social Security filing workbook. That is something that for your attendance here today that we are making available at no cost to you. And so we'll talk about how you may request that workbook, and we'll be honored to send that to you. And that will of course be a physical copy of the workbook. Secondly, we will go into a Q&A portion of our time. So if you've attended one of our workshops before, we also do workshops on things like taxes as well. And so if you've attended one of those workshops, you'll know that we do a Q&A at the end of our presentations. And so as some of you may have seen, I was able to highlight your comments and make them show up and make comments about your comments. And we'll do that during the Q&A. So you just type your questions in. During that Q&A time, I'll be able to tap on your question and I'll answer it. And that will all happen right at the end of the presentation time. Again, my name's MCCauley. In addition to being a national presenter of Einstein Retirement Workshops, I'll tell you a little bit about my background just so you have an understanding of my perspective when I do this workshop. I am the managing partner of City Center Financial, which is a retirement planning firm. That's obviously important from the standpoint of when I'm doing this workshop, the perspective I'm taking is how do these benefits fit in for you and your retirement planning needs? You know, it comes from our experience in helping now thousands of folks make good, high-quality retirement planning decisions. And so that's obviously the things when I share stories and ideas about things that'll be helpful to you. I'm thinking about other folks just like you who haven't had to make these kinds of decisions. I'm also a chartered retirement planning counselor, an accredited portfolio management advisor, and a national Social Security advisor certified professional. Now, we are not affiliated with nor are we employed by the Social Security Administration. Purpose of our presentation today is to give you advice, not to sign you up for benefits, okay? We do sometimes help our clients sign up for benefits, but that's not our job here today. Our job here today is to lend you our experience and expertise to give you some advice about things that could be meaningful to you as you're thinking about this Social Security decision. We are also able to provide that advice because of our firm, City Center Advisors, which is a registered investment advisory firm, and that allows us to provide advice to you in this way. Why is Social Security such a hot topic? Why are all of you here? Why do we do this week after week and we have hundreds of folks that attend every single week? Well, every day, roughly 10,000 new folks are turning 65, 70,000 a week, 280,000 a year, 3.64 million new folks are turning the subsequent ages to qualify for benefits like Social Security and Medicare. And so obviously there's just a lot of you, okay? That's A. And B, sometimes people get concerned. Hey, that's a lot of people who used to be working and paying taxes into this system. What happens now? They're going to be retiring. They're pulling dollars out of the system. You know, what gives? Is this system going to last? Are my benefits going to still be here? So we'll certainly want to touch on that. What does Social Security mean to you? Well, presently, 65% of middle-income Americans derive more than 50% of their retirement income from their Social Security benefits. Now, that's true, obviously, for those who haven't done a good job of saving other forms of retirement income. But even those who have put away dollars into things like 401k plans or brokerage accounts and maybe have accumulated pension benefits, you know, even for those, Social Security is often making up a very large percentage of the retirement income needs. I think if we were in a room together, and I've done this before in a room of folks, and I think if I said, hey, who's ever heard don't plan on Social Security? We might get all of you to raise your hand. And so the reality is the benefits are still here, and in many cases, they are quite good. And so it's not uncommon for us to see married couples with 50, 60, 70,000 or more dollars in combined benefits on an annual basis. And so if you've done the typical thing that many of you will do, which is try to get some spending needs down, get rid of some of the bills and those sorts of things to be able to retire comfortably on maybe a slightly lower income, well, good Social Security benefit's going to take up a big chunk of that need. Since 1985, pensions have been going away. We also see pensions being frozen. We've seen pensions, unfortunately, where the benefits are reduced even after people start taking them. And so that has obviously enhanced the need for these Social Security dollars. Now, our last statistic here, 46% of Americans currently pass away with less than $10,000 to their name. Now, this statistic is not here to frighten you, but it does help us frame in how should we be thinking about these Social Security dollars. You know, if you were to ask yourself, do you insure all the important financial things in your lifetime? You'd probably say yes. Do you insure your house? Yeah. Your car? Absolutely. Health? Yeah, you bet. Do you insure your retirement? The answer is probably yes. Okay, Social Security, if you frame it in properly, you think about, okay, what do these benefits mean to me? Okay, as retirement planners, when we think about these benefits, the way we frame that in properly is as retirement income insurance, or you could say longevity insurance. And the reason we frame it in like that is because these dollars will pay to you so long as you are still living. Even if you're this person passing away with less than $10,000 to your name, so long as you qualified for a benefit and you are still living, even if you are broke, you are still receiving those Social Security benefits. Longevity insurance or retirement income insurance can be pretty important these days, and the reason for that, really quite simple. We are in many cases living much longer than expected. Married couple, age 65, gentlemen, you have a 50% chance of living to 92. Ladies, your life expectancy goes all the way out to 97. So there again, even having these dollars paying to you, even if you live out into your 90s, very impactful, very meaningful. My granddaddy is a very good example of this. Passed away last year in December. Not COVID, just old age. He was 92 years old. Okay, he's right on for the stat. Okay, now making it to 92 isn't necessarily so remarkable by itself, except he had 4 heart attacks and 3 bypass surgeries before the age of 75. And so if you had asked him at 80, hey, granddaddy, you think you make it to 90? He'd have smiled and said, I don't think so. But medical technology, frankly, my granny, kicking his butt a little bit. They would curse me for saying it like that, but in any case, he still lived, right? He lived much longer than ever expected. So, in many cases, when you think about these benefits, maybe the better way to think about it is not so much how long do I think I'll live, but maybe how long could I live? Now, I don't know if you can live as long as this gal. This is Kane Tanaka. She is currently 118 years of age, although it has been a week since I checked, so I hope she's still with us. But last time we checked, she's still living. 118 years of age. She's from Japan. Interestingly, of the last 5 oldest living people, 4 of them were from Japan. So, I just like to highlight that in case you're thinking about doing any relocating. Japan might be the place to go. Okay, here's what we're going to focus on. Basics of how your benefits work, okay? This applies to everybody, okay? We want to make sure you have a good sense of some of the basics. Strategies for those of you who are married, okay? Specific filing strategies for married couples. Options for those of you who are divorced, okay? Divorcees have some specific needs that we'll talk about. Same thing for widows and widowers, okay? We're going to talk about that. And then if you do fall asleep somewhere in the middle, maybe because you're single or something like that, please do wake up in time for taxes. I can tell you, our organization has now helped thousands of folks make high quality Social Security filing decisions. If there is one single item that will take two strategies that kind of look the same, not too different. If I file this way, I gotta live, whatever age, and okay, fine. But it says, this one stinks, you gotta file like this, it's gonna be the tax issue. So I wanna make sure we spend enough time on that to give you a good understanding. Okay, some basics. Social Security, in order to qualify for a benefit, it is today very easy to find out. You just go to ssa.gov, create a profile, log in. One of the first things that you will see is a bunch of green bars, okay? If you don't have a profile at ssa.gov, I do encourage you to do that. Number one, because you can check your benefit statement and make sure it's accurate every year. Number two, you can file online, which is very easy and nice and in many ways much better than having to go to a Social Security office. But number three, also, you get to see, hey, am I qualified for my benefit? So those green bars go across, and if you get a green check at the end of those green bars, you have a benefit. So if you're not sure, just create a profile, easy to find out. In order to qualify, the rule is 10 years worth of work. It's actually technically 40 credits, but you can earn up to 4 credits per year. So you divide that out, it works out to 10 years worth of work. Once you've qualified for a benefit, the way your benefit is calculated is by using the highest 35 years of indexed earnings. A few things about that. Number one, it's not the most recent 35. It's not the most consecutive 35. It's the highest 35 no matter when they occurred. So for example, if you had 20 years worth of work, you took 5 years off and then picked up another 15 after that, no problem. That's your highest 35. That 5-year gap does not affect you. Now, once you have your highest 35, if you continue to work, does that increase your benefit in the future? It's a big maybe, okay? Your work today has to replace a lower income year in the past in order to increase your benefit for the future. Now, as you're thinking about that, you might say, well, I didn't earn much in 1980, so I'm earning much more today, so I'm probably increasing my benefit. Well, it depends, because it's not dollar for dollar the increase, it's the earnings today up against the earnings in the past after they've been indexed for inflation. For example, if I had an earnings of $20,000 in 1980, the way Social Security calculates that for my benefit is they multiply it by 4 and change. Okay, in the Social Security filing workbook that we're going to get you, okay, we'll talk about again at the end of the presentation how to request that. But in that workbook, there are indexing tables. And what you would see on that indexing table is that you could take that $20,000 that you earned in 1980, plug it into the indexing table, and you see that you need to multiply it by 4 and change, meaning $20,000 in 1980 is worth more than $80,000 in your benefit calculation. If that's your lowest income year and you're earning less than $80,000 today, then you're not replacing that year. And so your work today, while it's not hurting you for your Social Security in the future, it's just not helping you. Okay, what happens in the scenario where you don't have all 35 years? Let's say you only have 20 years. Well, in that case, what Social Security is going to do is they're going to take those 20 years, index them for inflation, and then add 15 zeros into your benefit calculation. So any additional work that you're doing today is replacing a zero and should have a pretty good size impact in terms of increasing your benefit down the road. If you have what is called a non-covered pension, this is the number one thing that folks have to deal with that can reduce their Social Security. A non-covered pension is a pension that you earned while you are not paying FICA taxes or taxes into the Social Security system. Government workers are the most often group who are going to deal with this. Many teachers' pensions are non-covered. Okay, some local municipalities non-covered. Often police and fire department pensions are non-covered. Okay, what that means is that if you have a Social Security benefit that you're also entitled to based on your own work history, you have the windfall elimination provision to deal with. Can't reduce your Social Security to zero, but the calculation's a little complicated. It is in your workbook. I don't have it memorized, but basically it has to do with the number of years of substantial earnings on Social Security that you have, and that will determine how much your Social Security is reduced by. On the flip side, if you do not have your own Social Security, but we're talking about a spousal Social Security and you have a non-covered pension, when you receive your non-covered pension, 2/3 of that amount counts against your spousal Social Security benefit. So you subtract it off. If that number is a negative number or goes to zero, the government pension offset can reduce your Social Security to zero. The windfall elimination provision, you'll at least get something. And there again, both of these are in your workbook. Okay, Social Security, I think you know this, but if you don't, you've paid a lot of money into this system. 6.2% of your pay has been going in for the last 10, 20, 30, 40, however many years you've been working. Your employer paid the other half of that for a total of 12.4% of your pay. Plus, of course, you were self-employed, then you got to pay both. But I think if you could imagine an account somewhere with 12.4% of your pay in it over all the years that you've been working, that might be a heck of a big pile of money. So maybe I'm preaching to the choir, but these are this benefit is an entitled program in the truest sense, okay? You're absolutely entitled to these benefits. You have paid for them. So, again, maybe I'm preaching to the choir because you're here, but do what you can to plan and maximize what you get out of this system. The situation in terms of how Social Security works is not as though you have an account with your name on it with your dollars in it. That would make sense, but that's not how it works. The way it works is as a pay-as-we-go system, meaning in 2010, we started being in the red, which means that the inflows from our taxes were not enough to cover current recipient benefits. And that's been true since 2010. We're still okay because the Social Security Trust Fund still owns a bunch of treasury bills. And so we're selling treasury bills and we have taxes flowing in and we're good through 2035. For a minute, we were at 2036. Now with the inflation estimate for next year, we're back down to 2035. What happens in 2036? Well, we'll see once they do all the calculating for next year with this inflation deal that we have going on right now. But at the moment, the estimate is that we'll be funded roughly 75 cents on the dollar beginning in 2036. Now, here's what that does not mean. What that does not mean is that in 2036, you can all expect a 25% cut to your Social Security benefits. Okay, that's not reasonable. The government generally doesn't like riots in the streets, generally. And so we need to be mindful of this, but the likelihood that this is going to affect any of you is very low. How can I say that so confidently? Well, current federal law says that once you hit 55, they cannot change your benefits. So that's A. B is, once you all have already experienced how they fix Social Security, and this will affect your children and grandchildren. Your parents had a full retirement age of 65. The oldest of you have a full retirement age of 66. The youngest of you have a full retirement age of 67, and then there's a whole bunch of you that have a full retirement age of 66 and some number of months, 2 months, 4 months, 6 months, depends on the year that you were born. Now, with that in mind, what did that do from going from 65 to 66 to 67? It effectively reduced how much you can get out of the system, but they didn't go in and slash your benefit amount. They just said you got to wait longer to get it, okay? So the probability that they'll do that again is very high. There's talks about pushing full retirement age for, again, your children and grandchildren all the way up to 70. There's talks of getting rid of the age 62 filing, pushing it all the way to 64. Okay, these are the types of things that are likely to happen. And there again, these things will affect your children and grandchildren. Okay, I know that many of you do have that full retirement age of 66 and some number of months, and some of you are 67. But just for ease of explanation, we're going to assume for a minute that everyone has a full retirement age of 66. If you file for benefits at your full retirement age, you are eligible to receive 100% of what is known as your PIA, or primary insurance amount. Your primary insurance amount is estimated for you on the very front page of your Social Security statement. That big bold number in the upper right corner, that is your estimated primary insurance amount. If you file for benefits at your full retirement age, we would, of course, anticipate that you would be receiving that full amount. So if that said $2,000, you file the full retirement age, we'd expect you to receive $2,000 a month. If you'd like to file early, you're allowed. You can file as early as 62, but it is a reduced amount. How much is it reduced? Well, that $2,000 would get reduced down to $1,500 if you file at 62. If you file on a delayed schedule, you could do that and be rewarded at a rate of 8% in what are called delayed retirement credits. 8% per year, simple interest, not compound, and that would turn a $2,000 a month benefit. As late as age 70, you could turn that into $2,640. If you delay past age 70, you can, but there's nothing in it for you, okay? There's no more increases. There's no benefit to delay past 70. Actually, 3 distinct benefits you can file for. The first is a retired workers benefit. This is a benefit that you're entitled to based upon your own work history. Spousal benefits would be benefits that you're entitled to based upon a spouse's work history or an ex-spouse's work history. And then widow or survivor benefits, of course, would be benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex-spouse's work history. The last time Social Security law was changed was October of 2015. Basically, what they did was they took away all the fun stuff. So if you've ever heard about file and suspend, get a lump sum check, these types of things, that is all gone, with one exception. Anyone born before January 2nd of 1954 who has not yet filed for a Social Security benefit, who has access to a spousal or ex-spousal benefit, can still file for that ex-spousal benefit or spousal benefit, called a restricted application, and wait to file their own. Okay, but you have to be born before January 2nd, 1954, and you also must not have filed anything yet. For those of you who are not in that group, or even that group, it's really just a couple of things to keep in mind about how you may file Social Security benefits. Number one, if you file for a Social Security benefit and that benefit you suddenly don't need, maybe you're laid off from a job and then you gained employment again, what can you do? Well, you can suspend filing for benefits at any time for any reason, and Social Security will stop paying you. From the point of suspension until you file again in the future, you will earn any increases that you are entitled to, okay? Next one. If you're doing that suspension and it's within the first 365 days from when you filed, you are allowed one time to rescind your application, meaning you would say, hey, stop paying me, and reset my benefit as though I never filed. Social Security will say, no problem. Just pay us back any dollars that you've been paid so far. So long as you do that, though, they will reset your benefit as though you never filed and allow you to earn all the delayed retirement credits up until that point. Okay. All right. Let's talk about married spouse benefits. In order to qualify for a spousal benefit, you do need to have been married for at least 1 year. In addition to that, the primary worker must have filed their benefit. So a spousal benefit, you're filing off of someone else's work history. that person must have filed theirs in order for you to file the spousal. Okay, it's called deemed filing. If you have your own work history and you think you want to file a spousal, you need to make sure that 50% of your spouse's primary insurance amount is more than your own. So if I have my own work history of $1,200, my wife has a work history with a $2,000 benefit, half of $2,000 is less than my $1,200. I don't get some of mine and some of her. It's not how it works, okay? It's just one or the other, whichever's higher. It's 50% of your spouse's primary insurance amount, not what they're receiving. So if John's primary insurance amount is $2,000, Jane is eligible for half of that at her full retirement age. But Jane could get less than that. How could Jane get less? Well, if Jane files early, she's allowed, she can file as early as 62. But she'll get less, just like if it were her own benefit. She's not going to get the full 1,000. She's going to get not $750. That's what she'd get if it were her own. No, spousal benefits are reduced on a faster schedule when filing early. So instead of $750, she's only getting $700 if she's filing a spousal instead of her own. Also, there's no delayed retirement credits for spousal benefits. If Jane has to delay till 70, there's nothing in it for her, okay? If it's her own benefit of $1,000, she can turn it into $1,320. But if it's not her own, it's a spousal benefit, it's not going to go up, it's going to stay at $1,000 even if she waits till 70. So there's no incentive for spouses to delay past full retirement age. Common scenario, John wants to delay till 70 and get $2,640. Jane doesn't want to delay. She wants to file at full retirement age. But John's delaying, so she's stuck. Except Jane has her own work history. She can file for a full retirement age benefit of $500. She should do that, okay? And she will collect $500 until John files at 70. Let's say they're the same age. And then when John files, she'll bump up from $500 to the full $1,000. Survivor benefits. Married couples, when one of you passes away, only one benefit remains, and it is always the higher of the two. So, if John has $2,000, Jane has $1,000, Jane passes away, John keeps his $2,000, but Jane takes her $1,000 with her. John has $2,000, Jane has $1,000. Jane passes away. I already did it that way. John passes away. Okay? Jane says goodbye to her $1,000, but she keeps John's $2,000. Okay? Only one benefit remains. It's always the higher of the two. The only caveat to this is the 82.5% rule, which basically says if John had filed early, say at 62, he's only getting 75%. So the 82.5% rule says that if John predeceases Jane, she'd get a small bump up to 82.5%, meaning that $1,500, 75% of $2,000, gets bumped up to $1,650. Okay, two most common mistakes that we see married couples making. The first one has to do with that survivor benefit. Remember, only one benefit remains, always the higher of the two. If that higher wage earner files early and then they die young, they could be shortchanging a surviving spouse. And if that spouse outlives them, say 20 years, that's 20 years with maybe a very small Social Security benefit rather than a larger benefit. And so oftentimes, if anyone is going to do any kind of delaying, it's going to be that larger wage earner because their benefit is the survivor's benefit. Second mistake that we often see is that both spouses delay past full retirement age. Maybe you're both still working, you don't necessarily need the dollars, so you keep it going. I can just tell you from experience, and again, the thousands of analyses we've run for folks, is that it almost never works out for both spouses to delay past full retirement age. Generally speaking, one spouse is going to file early to some degree or another, and one spouse is going to delay to some degree or another. Let's talk about divorced spouse benefits. In order to qualify for a divorced spouse benefit, you need to have been married for 10 years in a row to the same person. Okay, married 5 years, divorced, remarried, even to the same person, 7 years, divorced. 5 plus 7 does not equal 12. One of those two stints has to be 10 years in order for the ex-spousal benefit to remain. So I know that none of you came on here for marriage counseling. However, if you need a reason to hang on, there you go. You may not be currently married. If you had a marriage that lasted more than 10 years and you're thinking you'd like to file off of their work history, but you have a new spouse and you are now remarried, forget about the ex-spousal benefit. It's either your own or the new spousal that you're dealing with. Okay, same benefit amounts apply to the ex-spousal benefit in terms of no increases and delayed retirement credits, and extra penalties for filing early apply to the ex-spousal benefits in the same way that we described the spousal benefits. You are independently entitled. This is the big difference between divorce benefits and spousal benefits. It's called the independently entitled provision. And that means that if you've been divorced for at least 2 years, you can file those divorced spouse benefits whether your ex has filed their benefits or not. Remember my scenario, if John didn't file, Jane also can't file. But if they had been divorced for 2 years, doesn't matter when John files, Jane can file on her own schedule. Okay, rapidly diminishing group, but we're going to say it quickly. If you were born before January 2nd of 1954, and you've not yet filed for a Social Security benefit, and you're not currently married, and you have a marriage that lasted for more than 10 years, the restricted application may be particularly advantageous to you. Okay, one goofy thing about divorced spouse benefits. If you had a marriage that lasted more than 10 years and that spouse is younger than you, and you hit 62, and you start your own Social Security, a couple of years go by, your younger spouse hits 62, and now their spousal benefit, ex-spousal benefit, is more than your own, you can switch. If you manage to fit another 10-year marriage like that and it happens again, you can switch again. As many 10-year marriages like that as you can manage to pull off. Okay, common questions we hear from those who are divorced. I'm divorced. My ex is going to file off of me. Is that going to affect me in some way? No, it is not. I'm divorced. I've remarried. My ex is going to file off of me. My new spouse is going to file off of me. Are their benefits going to affect each other? No, they will not. I'm divorced and I managed to fit a few 10-year marriages into my lifetime, and they're all going to file off of me. My new spouse is going to file off of me, and I'm going to die young. No, okay, just kidding. All right, so all these people, yes, they could file off of your work history. The new spouse can file. It's allowed. It's okay. And yes, in fact, if you do die young, they can all get widow benefits. So that is how it works. Okay, I'm divorced. I'm going to file off of my ex's work history. Are they going to know that I've done that? No, they will not, okay? The only way they would know is if you told them. It doesn't affect them. Social Security doesn't give them a call and let them know. The only way they would know is if you told them. Those who are widowed, you're a special group. You're the only group who can file for Social Security as early as the age of 60. If you file for benefits at 60, you must have remained unmarried, or if you'd like to file at 60, you have to remain unmarried. So assuming you were widowed in your 50s or earlier, you have to remain unmarried until you reach the age of 60 for those widow benefits to be available. One of the very first workshops that I ever did, a gal in the back raised her hand during the Q&A portion and said, "So if I heard you right, it sounds like I need to delay the wedding." Well, in her case, it was kind of a big deal. This was a June workshop. Wedding was coming up in September. She's 59 years of age. She does not turn 60 until March of the following year. Let me give you what would have happened. If she remarried in September No more widow benefits available to her in March of the following year. What does that mean? It means she can't file anything until 62, so she's got to wait 2 more years to file anything. And the only benefits available to her at that point are either her own or her new spousal benefit. The higher of the two would have been the spousal, and it was just under $1,500 a month. Good spousal, but still just under $1,500. Her widow benefit was a nice widow benefit, just under $2,000 a month. So awesome, right? I gotta wait 2 years to get $500 a month less. So yeah, we did recommend that she delay the wedding. Now, I'm a religious person, so I think this is funny. You can decide for yourself, but she did go to her priest and said, so can we just do the religious part of the ceremony and sign stuff later? And her priest said, no. I said, there's got to be another priest. Somebody will do this for you. She's very devout. She delayed the wedding. All right. Last provision about widow benefits. You need to have been married at least 9 months prior to the death of your spouse in order for those widow benefits to be available. This rule is not here to hurt people. It is here to prevent deathbed marriages. Only real life example with this that I've run across, so it's not too common. But gal was married later in life. Husband was in the armed forces. He was shipped overseas, killed in action. They'd been married just less than 6 months. She thought, no widow benefits. Okay, didn't hit 9 months. But it wasn't as though he had a terminal illness or some known reason why he would be passing. We submitted the proper documentation, and her widow benefits were reopened. Another widow case study. Widows do get the most options on how they can file for benefits, and this case study will highlight that. John never elected for benefits. He died at the age of 64. His benefit at his full retirement age would have been $2,150. We never met John. We met Jane at a workshop. She had just turned 60 years old. She was 59 when John died. She didn't get remarried, so she's 60 and saying, what should I do about these widow benefits? Jane does have her own work history where she could collect at the age of 62 $1,197 a month. So what should Jane do? You know, John's benefit's $2,150, Jane's is $1,197, so it's natural to say, well, we probably want to go with John's, right? But let's think through this. If Jane files for those widow benefits right away, she's entitled to $1,537. So widow benefits, it is a reduced amount if you file at 60, okay? But that reduction would take John's benefit down to $1,537. If she collects that from 60 through age 85 and then she passes away, $461,000 over her lifetime. Now, the real Jane was still working, and so she would have to deal with the earnings test, which we'll talk about in just a minute. And so real Jane is not going to file anything yet. Just doesn't work out. So in her case, she wanted to work 2 more years. She did work 2 more years. And when she filed at 62, she gets to collect $1,197 a month. When she collects that, she can switch to John's widow benefit at her full retirement age and start receiving $2,150. So $1,197, switching to $2,150 at full retirement age. That's when you max a widow benefit, is full retirement age. And then over her lifetime, that's $77,000 more. Think that makes a difference to Jane? You betcha. Yeah, it makes a big difference. Also not assuming any cost of living adjustments. Difference would be bigger. Okay. Strategy 2. What if Jane was ready to retire? Okay, she was good. She didn't need to work anymore. She's going to retire. Well, in that case, she has to file for John's first. Okay, so she files for John's at 60. Collects that until the age of 70, $1,537, but then at 70, her own benefit, the $1,197, increases to full retirement age. Delayed retirement credits all the way till 70 is now worth $2,108 a month. So if she switches, she gets more than $100,000 over her lifetime just for understanding her options. As I'm sure you can all imagine, Jane is not going to get a phone call at 70 from Social Security saying, yes, hi, Jane. This is Social Security calling. We'd like you to know that you're missing out on some money. Yeah, that phone call is not going to come, okay? I think you can imagine that. Now, I'm often struck by these numbers, 400, 500,000. These are a lot of dollars. For many of us, this Social Security filing decision, very common to see married couples up over $1 million, sometimes over $2 million in combined lifetime benefits. This decision about Social Security may be one of the single biggest financial decisions that you ever make. So it's worth taking seriously. Probably preaching to the choir because you're here, but I am glad you're here because it's a lot of money, okay? It's your money. You've paid for it. Okay, earnings test. You are allowed to work and earn dollars, W-2, 1099, self-employment, and collect Social Security at the same time. It's allowed. If you are older than full retirement age, you can earn any amount and it's no problem. If you're younger than full retirement age, you're limited. How much are you limited? The first $18,960 that you earn, Social Security does not care. But the minute you go above $18,960 in W-2, 1099, or self-employment income, you have to deal with the earnings test, which says that you have to pay back $1 for every two you earn above the limit. Let's say that you have earnings of $58,960. How does that affect you? Well, $58,960 minus $18,960 knocks it down to $40,000. So you have $40,000 above the limit. It's a 1 for 2, so we chop it in half, which means that you are ineligible to receive $20,000 from Social Security. If the benefit you're filing for is $2,000 a month, $2,000 goes into $20,000 10 times, meaning Social Security will not pay you anything for January, February, March, April, May, June, July, August, September, October. Then you'll receive a $2,000 check in November and a $2,000 check in December. Some people mistakenly assume that they will simply receive a smaller amount but receive it all year. No. They simply will not pay you anything until you've paid back that which you were ineligible to receive. Now, the right side of this almost never applies to anyone, so I'll just say it briefly. In the year that you turn your full retirement age, but before you turn your full retirement age, your earnings test goes to $50,520, and it's a 1 for 3 calculation. Let's talk taxes. Taxes is the single biggest nightmare that faces Social Security recipients. That might be too strong of a way to say it, but let's just put it this way. Our firm, which we'll talk about in a minute, spent about $150,000 developing a software tool that we felt did a good enough job to help us plan for our clients in terms of how taxes affects our clients and when they're receiving Social Security and other forms of retirement income. So it's no joke. Now, we can know very easily that it's no joke because, good Lord, the IRS publishes Publication 915 every year. It's a 33-page document that will detail out for you everything you could possibly want to know about how you'll pay tax on Social Security. Why 33 pages? Call your congressman. Or lady. All right. This is a helpful thing on this document. This is a worksheet. This worksheet was very helpful to me. If you're very mathematically inclined, it might be very helpful to you. If you're not so mathematically inclined, well, let's just say it details out for you the 19-step process that you must go through to determine how much tax you will owe on your Social Security benefits. Here's what we're not going to do. During this workshop, we are not going to cover all 19 steps. What we are going to do is we're going to highlight some things that we think should be on your radar as you're thinking about how will taxes affect me in my receiving of these Social Security dollars. Line 1 is where you would put this wonderful number called provisional income. Provisional income is something you've never had to worry about until you decide to file Social Security. Then all of a sudden, it matters. It matters a lot. So what in the heck is provisional income? What's line 1? Well, provisional income is the number that everything else on this calculation is based on and will determine how much of your Social Security is subject to taxes. Now, provisional income is 3 items. Number 1, all of your adjusted gross income, all sources. Okay, earned income, capital gains, long and short, interest income, dividend income, annuity income, pension income, rental property income, self-employment, all the sources of income that you have. Doesn't matter what it is. Plus 2 additional items. First one stings a little bit, but doesn't affect a whole heck of a lot of people, but certainly some, and those of you who it affects, I'm sorry, because I know why you got it, okay? And that is municipal bond interest income. Municipal bond interest income, while it's not taxed at the federal level, does participate in your provisional income, which determines how much tax you will owe on Social Security. Wonderful. Item number 3 is the kicker. And I've heard people shout out things like, hey, that's double dipping and that sort of thing when I do this live. So if you feel that way, I get it. But item number 3 is 50% of the Social Security benefits you're receiving participate in the provisional income number that determines how much tax you're going to owe on Social Security. Now, if you are a single person and your provisional income number goes above $25,000, you start paying taxes on Social Security. If you're a single person and that number goes above $34,000, you could be subject to paying tax on up to 85% of your benefits. Married couples, provisional income above $32,000, you start paying taxes on Social Security. Provisional income of $44,000, you could be paying tax on up to 85% of your benefits. The question is, how much tax? Well, this is where it gets a little complicated. So let's think of an example. Say you're cruising along through retirement. You're enjoying life. Everything's going well. You've got maybe some pension or withdrawals from a 401k. You've got your Social Security benefits, and you're doing well. You're enjoying retirement. Everything's going great. And one day you wake up and you're thinking, gosh, I've saved some money and I've done some things and I've been a little cooped up and I'd like to go on a trip. It's time. Bucket list. Let's check off some bucket list items. And maybe you turn to your spouse or you talk to a friend or a loved one. You say, hey, I'd like to go on a trip. And you tell them about it and they say, that sounds great. And you say, well, I'll figure out how much this costs. So you start searching and booking and figuring it all out. And it's going to cost you $10,000. You're going to go on this trip. So book everything, get your $10,000 on the credit card. You want to pay it off, right? Let's get that credit card bill paid off. So where are you going to pull the money from to pay this off? Well, you survey your accounts, right? You've got all your various accounts. I need to pull $10,000 to pay for this trip. And you see, gosh, my 401k, that's done well. Keeps growing. Market's up. Cool. I'll pull my $10,000 from there. I mean, what did I save all this money for? Saved it for me. So I'll pull my $10,000 out of my 401k. Call up the 401k plan. Yes, I'd like to pull $10,000, please. They say, no problem. And then they ask you a very important question. How much tax would you like to have withheld from this distribution? Oh, yeah, right, taxes. Yeah. Sure, no problem. Yeah, I knew that was coming. So maybe you go to a tax return or you think about it, or maybe just no, okay? I'm in the 12% tax bracket, right? I'm not too extravagant or whatever, okay? But you're thinking, gosh, okay, 12%, that's what I'll pay. So you tell the 401k plan, I'd like to withhold 12%. They say no problem. They send you your funds. You go on your trip. And then in March of next year, you're punching it all into TurboTax or H&R Block or whatever your software of choice, or you've sent all your documents to your CPA or accountant or whoever's doing this for you, and all of a sudden you get a phone call. You owe tax. Or you're punching in the TurboTax and it's saying you owe money, and you go, well, I have not done yet. I still owe money. Wait, I never owe money. Why does TurboTax say I owe money? I'm done with my tax return. It says I owe money. That's wrong. I never owe money. Well, unfortunately, TurboTax is not wrong. See, what happened is when you took that $10,000 distribution from the 401k, you were in the 12% tax bracket, and it was taxed at 12%. The problem is that you were above these limits, and you didn't realize that you caused Social Security to become taxable. $10,000 here on the distribution, $10,000 here of new taxes on Social Security. You didn't get more money from Social Security, you just caused the benefits to become taxable. 12 plus 12 is 24%. Well, that's no fun. You don't like it. It's not good. You wish you hadn't made that mistake, but live and learn. You're not going to make it again. But I got to tell you, that is not the bad one. Let me explain the bad one. Bad one works like this. Many of you, I'm sure, have done a good job of trying to build up some savings for retirement. You've put the money in the accounts, you've gotten your employer matches, you took the money back from the IRS with the taxes, and so you worked hard and you saved, right? You built up a nice little nest egg with your 401k or employer-sponsored plans or 403bs or 457 or TIAA or TSP or IRAs or SEPs or Simples, all those types of accounts, right? You build up these accounts. And then you retire. But you've done a lot of the smart things, right? You didn't get to retirement by being dumb, okay? You got to retirement by working hard and getting the dollars and all that. And by reducing some spending, okay? Many of you I know have gone out of your way to try and get some things paid off. You try to get rid of the mortgages, card debt, co-signed student loans, some of you. You get rid of the credit card bill. Okay, all the different stuff, right? You try and get rid of all these things so that you can retire and not spend too much, because the last thing you want to do is get to your old age and not be able to care for yourself because of long-term care or medical expenses or whatever. Okay, maybe you have a friend or a family member who's had to do that and deal with that. You don't want that to happen to you. So, you do a lot of smart things. You don't have to spend too much. You're retired. Your account keeps growing. Hey, you're looking at the statements. That's great. My account. I got more money now than when I retired. And I've been spending a little bit. Wonderful. Except, one day you wake up and you're 72 years of age. Why 72? Well, 72 is when you must take a distribution from these 401k, IRA, 403b, 457, TIAAs, TSPs, all of these tax qualified accounts. Mandatorily, you don't have a choice. The larger the account, the larger the distribution mandatorily. Pushes you above these limits. Adds additional taxes to Social Security, but the distribution was so much that, whoops, now it's not 12 and 12 is 24, it's 22%, 22% is maybe 44. These are the types of tax mistakes that unfortunately we see people beelined towards them, and they're not doing anything to pre-plan or deal with it. We encourage you to deal with it ahead of time, okay? Don't push this off. The only way to deal with it is through pre-planning. Let's talk about a case study that highlights why all this is so important. Clients are 64 and 62. They have just over $34,000 in combined Social Security benefits if they file early. They're going to start their retirement with $752,000 in their 401k and IRA accounts. They need to earn they will earn 6% on those investments. And they're going to need to increase their $70,000 a year by 3% to keep up with inflation. They will live to 86 and 89 respectively. 3 groups of you are listening to me share this case study. The first group of you is saying, $752,000? What happened? Didn't they have any kids? Okay. Look, if you're listening to this and you're saying, yeah, that seems like a lot there, Kyle. I wish I had that. Well, then listen. This couple with $752,000 has a running out of money problem, and we're going to show how Social Security will help solve that. So sit tight. This will be very helpful to you. Okay, another group of you, second group of you, is looking at this and saying, yeah, tweak this number, modify this here or there, but yeah, it's pretty close. Looks about right. So obviously this will be very meaningful to you. And then the third group of you is looking at this and saying, Kyle, I knew you were going to say they're going to run out of money. Yeah, they didn't work long enough. They got to keep going. They didn't save enough. It's not going to happen. I knew it. Okay? Those of you who are saying that, I need you to pay attention, because this couple with only $752,000 has a tax problem, and we're going to show how a change in their Social Security strategy can help fix that. If this couple retires, files Social Security early on, blue lines, the Social Security benefits, yellow lines, or maybe it looks orange to you. Yeah, it looks orange to you. Okay. Orange lines, dollars coming out of their investment accounts. Red line is what they need to hit to keep up with inflation. That's their spending target, increasing with inflation. The yellow line or orange line above the red line is the amount they are paying in taxes. Because of that double taxation process I described a moment ago, you are seeing correctly that taxes are not increasing linearly. They're increasing exponentially. Secondly, Social Security doesn't keep up with real inflation. That's correct. Historically, Social Security lags behind real inflation by about 1%. So, although they need to increase their spending by 3%, Social Security is only increasing at about 2%. Lastly, because they're putting all this pressure on their investments, they're having to take out more and more every year, paying more and more in taxes, they run out of money 14 years too soon. Now, the only difference between this slide and the next slide is a change in the Social Security filing strategy. We are not doing any advanced tax planning, Roth conversions, restructuring accounts, none of that stuff. Okay, they would benefit from this stuff. I mean, many folks benefit from that type of planning, but we're not doing any of that. What we are doing is modifying their Social Security strategy. Just a change in the Social Security strategy is going to make a huge difference for this couple. Let's take a look. If they will fund the early years of their retirement entirely out of their 401k accounts, you'll notice that they pay a little bit more in taxes. But look at this. Their taxes drop down to almost nothing. I don't know if you can see it, the orange lines above the red line. There's a little bit there, but not much at all. It is not uncommon when we do pre-planning for folks to get them into a position where they pay very little and sometimes even zero taxes once they are retired. Honored to say that I like when I can pull that off. Just had a meeting earlier this week with a client where we pulled that off, and so they're going to be retired paying 0% federal taxes. Little state income tax, it's a bummer, but so they're not tax-free, not entirely, but close. Okay, just a little state tax. Okay, this couple, once they file Social Security, it's covering so much of their income need. Social Security is actually tax advantageous so long as you build your plan such that you're not taking too much from other sources and generating that double tax. As long as you avoid that, you can really do a good job at minimizing the short-term and maybe even also the long-term tax exposure. Now this couple, because there's no advanced tax planning, no Roth conversions, eventually they start paying some taxes. But you'll also notice we took all that pressure off of their portfolio, and their portfolio lasts their whole lifetime. From a tax comparison perspective, you can see that in the early years, this couple pays more in taxes when they delay Social Security early on. but look at all the excess taxes, the orange lines above the blue lines, that are being paid simply for filing Social Security early. Now, eventually they stop paying taxes, but they're broke, so it's not a good deal. If they optimize their Social Security situation, a few things happen. Number one, they get $186,000 of additional Social Security value, 14 more years out of their portfolio, and they pay $35,000 less in taxes, even though they weren't paying any taxes for 14 years when they went broke. So that's a win across the board, I would say. A couple of quick things about your Social Security statement that's good for you to know. Number one, no cost of living adjustments are applied to that statement. It's just a snapshot in time of today's benefits. Okay, so if you like to estimate future benefits with cost of livings, that's not going to do it for you. Assumes you work till 62, retire, and file immediately. Or work until full retirement age, retire, file immediately. Or work all the way till 70, retire, file immediately. Okay, it doesn't factor in what if you retire at 65, delay Social Security a couple years. That's not on your statement. Your work history only, no spousal coordination, no widow benefits or ex benefits, none of that, and certainly no advice. So, if you feel after hearing our presentation today that you could use a more individualized, specified assessment or analysis of your Social Security benefits, I want to make available to all of you for attending a complimentary Social Security analysis. This complimentary Social Security analysis is provided by my firm, City Center Financial, in conjunction with our educational brand, Einstein Retirement Workshops. This Social Security analysis will be complimentary to you if you choose to take advantage of it. Let me tell you a little bit about what is in this Social Security analysis if you choose to take advantage of it, and let's talk a little bit about why we provide this to folks. So number one, we're going to give you specified filing strategies. If you get this complimentary analysis from us, we're going to show you very specifically, here's the best way for you to file. We'll also compare it and look at multiple filing strategy options and look at those and give you a sense of when your best timing will be. We'll also look at a break even, when is the best time to file, if you live to different ages, how does that affect things? We will look at all of that with you. Now, here is the big, most important part of this analysis. This analysis, the Social Security analysis, like this, just the basic part, I think we do a great job of it. Our experience probably gives us a little extra insight. The fact that all of our advisors are National Social Security Advisor certified professionals probably gives us a better just baseline Social Security analysis compared to what you might receive from most folks. But the thing that sets it apart, the thing that will cause you to say, wow, I'm so glad I did this, I'm so glad I met you guys, is going to be this part of the analysis. This is our retirement income, cash flow, and tax analysis. This analysis allows us, this is that $150,000 software. I laugh because I think if any of you are in business or, have had to make decisions like this, many of you know that oftentimes there's subscription software tools that are, $30 a month or something like that. And I would have gladly paid $30 a month for this type of software tool if it existed, but it doesn't exist, okay? That's why we spent the money to develop it. And the reason why it doesn't exist is because this software tool gets down into granularity, a very significant amount of granularity, so much granularity, in fact, that it allows us to do a level of detailed planning that is just, you're not going to get anywhere else, okay? And I mean that nicely. There's many advisors who like to talk about tax planning, but we actually do it, okay? Roth conversions, $42,350, okay? It's not uncommon for us to have that number say $42,352.85, okay? I mean, that's the level of specificity. And why that Roth conversion amount? Well, this couple has a good amount of IRA assets, okay? And I'll show you in a second, but this kind of conversion strategy gets them in a position that they never pay the 85% on Social Security ever again. Okay, that's the kind of value that this analysis can provide to you. Okay, if we look at what's the long-term effects of doing a Roth conversion strategy, well, this couple gets an additional $700,000 in completely tax-free Roth dollars by using a Roth conversion strategy. You can see this couple has about 1.4 million, and so this kind of analysis with that amount of savings, more than $1 million, just over $1 million of qualified accounts. I mean, these are the types of things that we have to take seriously. If you're in that million plus kind of range and in IRA dollars, it's not time to mess around. Okay, we're in crunch mode. Between now and 2026, we have a very good tax code. It's not time to mess around. It's time to get serious about tax planning and take advantage of the current tax code. Try to optimize your plan so that once you're in retirement, hopefully we can do some planning to get you out of that 85% tax on Social Security. Okay, this is the type of thing that can be very helpful to you. If you're less than that, I mean, very often we see people at 500,000 in qualified assets. Maybe we get it all converted. Maybe we get you into a position where you're in that 0% tax bracket. Okay, a couple 100,000 of IRA, probably can get it all converted. I mean, it's really possible, and we're so excited when we're able to do that kind of planning for folks. So whether you're in crunch mode or you're in, hey, let me enjoy a really good tax rate, maybe even no taxes in retirement, we'd love to help you with that kind of planning. Okay. All right, we're going to go to questions just in a minute, but a few things about the analysis that I want to say. Okay, when you go to sendworkbook.com to request your Social Security filing workbook, this is a free workbook. It's complimentary for you for attending here tonight. We're happy and honored to send this workbook to you. Okay, sendworkbook.com is where you will go. If you are serious about retirement planning, maybe you recognize that you don't have a plan yet. Okay, you've been gearing up for retirement, you've been going along the way, and you're thinking about retirement, but you recognize, I don't really have a plan of how this is going to go. I can't see clearly, what's coming down the pipeline for me. Then look, this analysis process is going to be very meaningful to you, and I encourage you to take advantage of it. Okay, if you're the type of person that's saying, gosh, I have an investment broker. Maybe I have an 800 number. I can call my 401k plan and ask their some tips. I struggle to say the word advice. I can ask some tips from them, but you realize that they're not really helping you in the way that you need. They're not helping you with the level of specificity that I just highlighted for you. They're not giving you the exact advice as you are getting into retirement that tells you exactly, here's the best way for you to be pulling from your various accounts. Here's the best way for you to coordinate those investments to make sure you're getting the most out of your situation. I mean, let's just put it like this. If we can generate a 2%, what we call alpha in our industry, by optimizing tax planning, and we do as good or better than your current investment situation, I mean, over a 30-year retirement, that's 60% return on your investment for taking advantage of the tax planning strategies that our firm offers. So that analysis process to you, if you're serious about retirement planning, you're thinking this is something that could be really helpful to you, we invite you to take advantage of it. How would you take advantage of it? At sendworkbook.com, you're going to have that same opportunity. After you fill out the stuff for us to mail you the workbook, you'll be able to say, yes, I'd like to take advantage of my complimentary Social Security analysis, and we're honored to do that for you. Okay, a few quick things. City Center Financial, my firm, owns and operates the Einstein Retirement Workshops brand. We used to be two separate entities, no more. We acquired this brand, and it is now our firm. So I want to be very clear about that. Secondarily, all of our advisors, fully licensed, certified, all of them National Social Security Advisor certified. We demand that. We do not allow people to be affiliated with our firm and working with our clients for the level of planning that we're talking about if they don't at least have a National Social Security Advisor certification. I mean, how can you possibly be an expert on Social Security without real education? The law is over 3,600 pages. It's just not going to happen. 2,600 pages. So it's something that we demand. Also, all of our advisors are fiduciaries. They're also all trained by me, And so if you are serious about your retirement planning needs, you're excited to take advantage of the analysis, again, we invite you to do that. We'd love to do that for you and get started on this retirement journey together. Okay, if along the way, once you have received your analysis and we're talking about what does it mean for us to assist you with your retirement planning needs looking forward, then we're going to be running that Retirement Defender Screening Report. You'll see that also at sendworkbook.com. And we'll start evaluating your specific retirement planning needs and start talking with you about solving those needs and concerns. The way our clients hire us is through fees. We are a fee-based firm, and so what that means is you can hire us with planning fees or investment advisory fees. Most of our clients pay investment advisory fees, and on average, our clients pay 0.82%. Could be slightly higher or slightly lower, depending on your specifics and the type of investing strategies that we're implementing on your behalf. Okay, with that, I'm going to start answering questions. Type them into the chat, either on YouTube or Facebook. I'll highlight them and we'll start answering them. At any time, you can go to sendworkbook.com. Just go into the website, open a new browser tab. If you're on your computer, do it on a phone or vice versa. Want to make sure we get you that workbook, so go to sendworkbook.com, and we're honored to get that going for you. And with that, I'll start answering questions. Okay. Okay, so Renita says, wow, how can anyone without provisional income afford to retire and pay taxes? Well, that's a great question. Again, most people do pay taxes on Social Security, but if you can manage to do some planning, that's where you can maybe get out of that. Okay. Gwendolyn says, what happens when a spouse is passed and the other spouse did not pay into Social Security, as she worked for the federal government and did not apply for Medicare and spousal benefits until after her spouse passed? What is the penalty for not filing and the spouse work for the federal government? It kind of depends on a few other factors, Gwendolyn. Okay, he had passed in his 80s. You have a little bit more there, and she can't get the spouse's Social Security. How does this happen? Yeah, so the issue is because the spouse did not pay in the Social Security system, they're dealing with the government pension offset, and that's reducing Social Security to zero. So unfortunately, that is how it works. Okay, Kathleen says, I don't have any investments at this time. However, I will be getting some because of our mother's estate. Okay, I'm full retirement age. Is there anything you can do for me? Yeah, you just want to make sure, because if you start investing the cash that you're going to receive, you want to be mindful of the types of investments you pick up and the type of taxable income that those are generating, because you'll want to be optimizing that, because very likely, depending on how much it is, there is a possibility that you could be getting completely tax-free retirement income, so long as you manage the type of income you're getting out of those new dollars that you just inherited. Okay. So the question, so cash out of the estate. Yes. Yeah. Okay. Yep. Exactly. Okay. Do I have to apply for Medicare if I have VA medical? The answer is yes. Yes, Valerie. At 65. Mm-hmm. Okay, Becky says, do you require a minimum that we have saved for you to do the analysis? No, Becky, we don't require a minimum, but we just ask, again, it's a complimentary analysis, but it is going to be something that at some point we provide that analysis with the view in mind that you'll see the value of that, and we may earn the right or the privilege, maybe I should say the honor of serving you with other retirement planning or investing needs that you have. So no, we don't have a specific minimum, but obviously, depending on how much you save, that will determine how much we can really optimize your plan and help you, okay? I guess I would say, if you're thinking seriously about having us assist you with retirement planning, take advantage of the analysis. If it doesn't work out for some reason, no hard feelings. Okay, Lee says, how do I find out if my ex has started collecting Social Security? Well, Lee, it doesn't really matter, right? Unless you have been divorced less than 2 years, then it does matter. But as long as you've been divorced for 2 years, it doesn't matter whether your ex is filed or not. You can file on theirs regardless. Okay, Valerie says, does my Wisconsin pension count against my $18,000 of allowable income? No, Valerie, it does not. Only earned income, so W-2, 1099, or self-employment. Okay. Elizabeth says, I am presently working. Can I apply for my ex-husband's pension while I'm working and later switch when I'm 67? I was married for 14 years. Elizabeth, you just have to deal with the earnings test, okay? 18,960 is the top of the earnings test. Certainly it's, actually, no, I'm sorry. I just saw age 67. So the answer is no, sorry. Redo that, okay? The only way would be if he predeceased you. If he's deceased, then the answer is yes, you could, but you have to deal with the earnings test. If he is not predeceased you, then no. Okay, you are too young, far too young, to do that type of strategy. Okay, Nancy says, would it be wise to live off your 401k now before filing? Okay, Nancy, so you're thinking exactly down the path that we just discussed, right? So that is a strategy that often is helpful to people in your specific circumstance. That's what the analysis is for, right? That's for us to dig into the details with you and help you determine that. Okay, Mary says, I would love to retire now on widow benefits, but what about health insurance? Yeah, so Mary, obviously, if you're not 65 yet, you're going to need to go to healthcare.gov and sign up for a plan through that system. There are ways to get subsidies depending on your other sources of income. Okay, Glenda says, I became disabled in 2002. I think you have more to that question. Not sure what it is. Sorry to hear about that, Glenda. Okay, Wolf Studies says, we will be getting my husband's pension and then our 2 Social Securities. How does that get taxed? So it's the provisional income calculation, Wolf Studies. So the 50% of the Social Security plus whatever the pension amount is, add those 2 together. If it's above $32,000, you start paying tax on Social Security. Again, the calculation gets a little complicated. If you're getting the analysis, obviously we'll be able to answer that for you and all of that. Okay, Patricia says, I'm 60, a postal worker with 31 years of service. I have a Roth IRA of $25,000 and a traditional of $100,000. Okay, great, single. When should I retire? Well, Patricia, I would love to answer that for you, but we have some outstanding questions, right? So sounds like the analysis would probably be very helpful to you in this situation. But the question is going to be, how much income do you need to be retired? Do you have a pension from the Postal Service, or are we dealing with Social Security, or do you get both? Okay, depending on when you were hired in, that could factor into that. And so these are all questions that our team would help you think through. Okay, my ex is 3 years younger and is on disability. I just retired at 62. Can I collect on her Social Security? No, sorry, Roger, you are too young. Will this presentation be available to watch later? It'll be up for about roughly 12 hours, is usually how long it's up for. Will the full retirement age change in a few years from now? It's possible. New York City, Ronan, NYC, I assume that's what that's for. It's possible, but if you're over 55, it's not going to affect you. Current federal law says they can't change yours. Okay, I'm 64 with absolutely no retirement savings. I plan on claiming at Social Security at 70, continue to work at that time. Is the analysis just a waste of your time in that circumstance? Well, I mean, obviously, there's no real situation where we're going to have you as a client doing investing strategies for you. But I'm not sure that it's going to be a great benefit necessarily for you. But if something I said in the process caused you to say, hey, maybe there's something here, again, we do offer it complimentary, but I'm not sure necessarily that that's going to be there's going to be some huge revelation or something like that, okay? Unless you're starting to put some savings away and you need help with that. That's the only thing I could think of, John. Okay, Glenda says, I became disabled in 2002 and started drawing Social Security. I turned 62, so will there be any difference in my pay? No, Glenda, so it's actually not till your full retirement age, and then you'll get a letter saying, hey, we switched you to full retirement age benefit, and all that means is that you could go back to work if you wanted to, right? With no issues on disability. I assume that that's not a possibility, so it probably doesn't make any difference. Okay, Robin Lewis says, my husband already started taking Social Security at 62. How will that affect my filing? Well, Robin, it depends on a lot of other factors, but depends on whose benefits higher. Is yours higher? Would it maybe affect you to where you might want to delay somewhat so that you maximize the survivor benefit? That could be a possibility. When are you planning to retire? What kind of income needs do you have? Can you afford to delay your benefit possibly and do that kind of help? I mean, there's a lot of factors into that question, Robin. Okay, New York City Ronan's concerned about Social Security. Is it going to be replaced by a 401k in the future? Very unlikely, I would say. Okay, Ruben is asking, if we transfer my wife's Texas teacher retirement into an IRA, will she qualify for my Social Security benefits? Well, it's not an uncommon question, Ruben, and it's something that you want to be very careful in your planning about. But the short answer is no, there's a calculation that goes in to still figuring that part out, okay? So it's not a get out of jail free card, that strategy. But I like where your head's at. It's something, obviously, when I first learned about all this, I thought maybe, but no, unfortunately. Okay, Patricia is asking some investment advice. Should I put my IRA in the AIG fund? Well, Patricia, I don't know enough about your circumstance to give you any specific investment advice recommendations. That would not be prudent of me to do. But again, if you're going to go into the analysis process, obviously we can get into discussions like that and talk about what are going to be the best investment strategies to give you success in retirement. Okay, but I appreciate the honor of asking. I'm honored that you wanted to do that. Okay, there again, sendworkbook.com is where you want to go. Subscribe to our YouTube channel. Follow our Facebook page. We'd love to see you at future events. We're about to kickstart our daily podcast again. We've been on a little vacation from that as we've thought through that process and kind of tried to decide how we want to handle that. If you've seen our podcast, we are certainly happy for that, but do check that out. We would love to engage with you at future workshops, as I said. And there again, sendworkbook.com, request your filing workbook, the analysis. If you are going to get good value from that, we invite you to take advantage of it. We'd love to work with you in that way. And with that, we will wrap up for tonight. Thank you all for your questions. We look forward to interacting with you more in the future. Leave comments and leave reviews on our various pages if you got great value from tonight's presentation. It's helpful for others to let them know that you got some good value, and we're happy to do that. With that, although I just see someone says, how do we get our questions answered? I saw that there were no more questions. Colleen, you just type it in, okay? I don't know if there's a problem, but just type your question in and I'll answer it for you. If you're talking about more specific questions to your specific situation, you want to sign up for the analysis. Okay, the analysis process is where we help folks really who are gearing up for retirement get those plans together. You know, this is not time to mess around. If you're gearing up for retirement, I mean, are we in a more uncertain age right now from an investment perspective? Inflation's ticking up higher than expected. Interest rates are still very low, which hurts our safe investments in a big way. We got to take this very seriously. It's not time to mess around. It's time to get serious about your planning and work with a firm that can help you think through and make these good decisions. Okay. Colleen said I did 2 times. I didn't see your question, Colleen. I'm sorry. I'm seeing them now, so maybe if you want to type it in again, I'd be happy to answer it. Okay, I'm 64 and plan to retire next year and wait for my full retirement age to begin Social Security. My wife is 61, and she plans to begin, maybe you're saying disability? I'm not sure. Okay, I mean, that's okay if you do that. I'm 63 and drew out Social Security at 62. I'm working now and have saved $200,000. Can you help with investments? Yes, Pamela. Yeah, we can absolutely help with that, and we'd be honored to. Just simply request the analysis, and we'll work with you on that. Okay, again, our investment advisory fees are on the lower end of things for those of you who haven't yet gone through the Send Workbook process and are going to sign up for that. Let me just address. Our investment advisory fees are lower than the national average, and I would say that we do a better job and provide a better service than all of our competitors combined. What else am I going to say? So why are we cheaper if we're so much better? Well, we work with you virtually, okay? We don't plop offices across the country. I mean, I can think of some firms that you can drive into any small town and you can see their office. That's not us, okay? We work with you over video conference. We've elected to do that. We've stayed true to that process. And what that allows us to do is, because we're not putting brick and mortar everywhere, okay, we're allowed now to keep our fees lower. We're able to operate more efficiently, and that's able to save you a lot of money. And so that's how we operate from that perspective. Okay, all right, we're going to wrap up this time for real. Sendworkbook.com. We'd love to interact with you. Happy to have you here tonight, and we'll see you next time.